Hello everyone and welcome back. This is the third video in a series of videos. I am talking about my journey of building a home in Kenya. In the past two videos, on the first video we covered a topic of do you need a home in Kenya? We covered buying versus building a home in Kenya. On the second video, we deep dived into do you really need a home in Kenya? Okay. And then we also covered the different kinds of properties that you can buy in Kenya that are available and commonly advertised in Kenya. On this third video, I'm going to purely cover how to fund your project in Kenya. So let's go ahead and get started. Again, my name is Dennis Otieno, and I'm going to walk you through my journey, my pain points, what I learned, and maybe you can get something out of these videos. Many years ago, I started building a home in Kenya, and I bought a piece of land by the beach, and I built this home. Now, this journey has not been without its pain points, of course. Anytime you're building something, it requires a lot of resources, a lot of time, and a lot of decisions to be made. Being remote does not make it any easier. And that is why today I want us to cover one important topic. This pertains mostly to people in the United States. If you don't live in the US, this may not pertain to you, but please join us and let's move forward with this. Funding your project in Kenya. There are many ways that you can fund your project in Kenya. Okay. You can cash flow the project. You can do a 401k withdrawal. You can do a 401k loan. You can do a home equity loan if you have a home in the United States. You can do a home equity line of credit if you have a home in the United States. You can do a cash out refinance if you have a home in the United States. You can get a personal loan. You can use credit cards, or you can get a loan from a bank in Kenya. Each one of these topics we are going to walk through in detail. Building with cash. This is the most important one. Let's start with this, right? My personal experience, I built my home, I cash flowed my home. And so this example that I'm going to give here is something that I have done. First of all, you need to consider expanding your earning capacity. The first thing that I had to figure out was how do I generate income streams, either from a second job or a gig job or something like that. Maybe you work during the day and you drive Uber at night. In my case, I'm a real estate agent, so on the weekends, I'm always busy looking for houses, shooting videos, and taking people to see homes. That is my second stream of income. You figure out how you can get a second stream of income. If possible, have your primary income stream from your job dedicated to your household expenses in the United States, while your secondary income stream, you can dedicate that to your project in Kenya. I do not recommend mixing the two. Unless there's an emergency, I really do not recommend mixing the two. But we'll talk about that word emergency in a little bit. You need to know your limit, okay? Know your spending limits. Do not overcommit or overspend. Construction is a marathon. It's a long-term thing. It's not a sprint. It's not something you're going to start today and finish tomorrow. Yes, if you're cash flowing, it's going to take you many years. My home building alone is going on 10 years now. Okay, so it's taken a while. Okay, but I'm not swayed by that. Some people will talk negatively. Some people will say things, But you need to consider this. This is not a home that you're going to live in all the time. You live in the United States, you go to visit there maybe once a year, maybe twice a year, maybe once every 3 years. So there's no urgency for you to immediately finish that home right away. Well, that is the decision I have to make. Be prepared to take breaks if you're building with cash, because occasionally you'll need to stop the project for an extended period of time to save some money. Because we also know in the US we have demands, things come, things go, you lose jobs, you get jobs. So you may want to consider that and be aware that in some times you need to take a pause, take a break on the project, and then come back to it. On the first sign of trouble, you need to stop the work. This is very, very important. When you see things not going too well, you really need to stop the work. Okay? Avoid compromises and workarounds. It is always cheaper to redo something now than to redo it later. Many people in the diaspora know this. We have problems with quality and quality workmanship in Kenya. So you will find yourself doing something, knocking it down and redoing it. Be comfortable with that. And if you're cash flowing the project, by the time you're done, like myself, you may end up having spent enough money to build 3 houses instead of 1. And that is just because you'll occasionally be knocking something down, stopping the project, redoing something. This is very common. However, the only takeaway I want to give you here, if you're going to build with cash, consider getting an additional income stream to help support your project. If you do that, you'll be at peace in your household. 401k withdrawal. This is another way to fund your project in Kenya. Let's talk about this. I would say this should be the last resort, because is it really an emergency for you to build a home in Kenya? I don't think it is, but your situation may be different. So what is a 401k withdrawal, right? You can either do a loan where you take a loan against your 401k, or you can do a withdrawal. If you do a withdrawal, they give you the money, they charge you taxes, they charge you a penalty for early withdrawal if you're not 59 and a half years old. And you need to consider those, because those taxes can be substantial. Okay? If you do a 401k loan, you get the money immediately. But you also miss on the growth opportunity, because the money you borrow is not being used to calculate your returns on the stock market. So you need to be aware of that. Normally, these loans are low interest loans. The interest you're paying back is actually being applied back to what you borrowed. So basically, you're paying yourself back. Of course, when you're paying off these loans, you are using money, your net income, money that has already hit your bank account. So basically, you see this as double taxation, because you're borrowing against yourself, paying yourself back. And when you go to withdraw the money when you retire, you're going to be taxed on it. So typically, this is called double taxation. If you borrow against your 401k loan, it will never appear on your credit score. Okay, unless you fail to pay for it. The most important thing I need you to hear, if any, on borrowing on your 401k loan is if you leave your job, whether you are let go, laid off, fired, or you quit, the full loan balance is often due within 60 to 90 days. And if you don't pay it back in full, it will be considered a withdrawal, and you'll get a penalty plus a tax. So this is important for you to know. In fact, some employers won't even allow people to take 401k withdrawals anymore. Typically, 401k withdrawals can have low interest rates, definitely lower than credit cards or personal loans. Most people miss out on the growth, because remember, there's always the compound growth, compound interest, right? If you withdraw money, it's not there to earn the compound interest. So you lose on it. If you fail to pay, as I said earlier, or if you lose your job or you get fired, the loan becomes 100% due within 60 or 90 days. You need to be very familiar with this. But the good thing is there are no restrictions on how you can use your 401k funds. You can use them just about anything. The next popular way that you can get money is home equity loan. Okay. Again, I still ask, is it really an emergency? Do you have to have a second mortgage on your home to fund a home in Kenya? Let's talk about what is a home equity loan. A home equity loan is where you are taking the equity out of your home. The equity out of your home is when you subtract the market value of your house. Not how much loan you have on it, but the market value of your house minus how much money you owe on the house, on the existing mortgage on your house. That is your equity. Your home could be worth $500,000, $500,000, and you owe, let's say, $400,000 on a mortgage. You have $100,000 in equity. You can borrow that. Typically, most banks will reserve a 20% cushion of the equity. They will not give you $100,000, all of it. They'll give you more like 80,000, maybe 80% of it, because they typically want to hold about 20% equity on the loan, or on the home, okay? Just to make sure that you don't withdraw all the equity in the loan. Now, remember, a home equity loan is basically taking a loan out of the equity that you have on the home. Typically, these have very low interest rate, which is very nice. You get the full amount of money immediately. The payments are fixed, meaning there's a fixed interest rate. And if you use them for qualifying improvements on your home, you may get a tax deduction. But I would say talk to a tax advisor before you do this, because qualifying home improvements are the only things that qualify for tax deduction. So what are some of the risks of taking a home equity loan? Remember, this is a second loan to your primary loan. You still have the original loan that you have on the home. This is a second loan. It becomes what we call a second lien on your property. The primary mortgage or the primary lien, if you go on a foreclosure, that has to be paid first before the second lien. And the second lien is normally your home equity loan or your home equity line of credit, okay? If you default, that is how they typically pay off those loans. And because the second lien, home equity loan or home equity line of credit, is riskier, remember, they don't get paid until the primary lien is paid. Their interest rates tend to be higher. Also, some lenders may charge closing costs on home equity loans. You need to factor in those costs because they're going to reduce the amount of money you can get. The repayment terms on home equity loan can be very extended. So this could be 20 years, 30 years, just like a regular mortgage. And also depends on how much money you borrow on your equity. So what are the things you need to consider? I would say consider this for maybe long-term investments or something that is long-term. I would not recommend taking a home equity loan to go on vacation. It makes no sense to take a second mortgage on your home so you can go on vacation, on a cruise, eat some food, come home, and continue paying for that cruise 30 years later. That makes no sense to me, but maybe it makes sense to you. This requires a stable income because remember, you still have to pay your primary mortgage. This is a second mortgage. A home equity loan is basically a second mortgage on the home. So you are paying two loans, which means you have to have enough income to cater for that. Market conditions may also affect you, like falling home values. So the example that I gave, your home is worth 500,000. Let's say there's a change in the market conditions, and now your home is worth 400,000. But remember, you owe 400,000 on the original loan, and you owe another 100 or 80,000 on the second loan. You owe more than the home is worth. You need to be familiar with home equity loans before you take one. Another one is home equity line of credit. I have highlighted a video here for you to watch. So if you can go to YouTube, search for this video. I'm going to pause so you can take a screenshot of this so that you can go search for this video on YouTube. It explains home equity line of credit very well. Just go to youtube.com, go and type this on the search screen, and this video should come up. The lady is called Julie Felsman. Very good explanation. Let's talk about home equity line of credit next. A home equity line of credit is basically using your home as a credit card. It's similar to home equity loan. The only difference is that instead of getting all the money at once, like you do with home equity loan, with a line of credit, they give you essentially something like a credit card. Some lenders will actually give you a card, almost like a credit card. So essentially what they do is they say, let's say you have 100,000 in equity on your home, they'll give you that 100,000 as a credit. You can withdraw against that 100,000. You can withdraw 5,000 today, 6,000 tomorrow, 3,000 next day, pay it all off, you still have 100,000. And keep withdrawing. And you can continue doing this just like you do with a credit card. So a home equity line of credit is basically using your home's equity as a credit line. Remember the question, is it really an emergency? Do you really need this? Only you can answer that for yourself. The advantages of using a home equity line of credit are flexible access. You can only borrow what you need. They may give you a line of credit that is 100,000. You only use what you need. You can pay that off, or you can continue to borrow. If you watch that video, it explains something called a revolving credit, right? And then there is a repayment period that you have to consider when you're taking a home equity line of credit. They typically tend to have lower interest rates. And in the beginning, initially, you only pay interest payments within what is called a draw period. Okay? What is a draw period? When you take a home equity line of credit, remember they give you that equity of, let's say, 100,000, right? They're going to give it for you to use within a certain period of time. During that time, let's say they give you a period of maybe, let's say they give you 5 years, okay? You have 5 years, $100,000 to use, okay? You can withdraw back, forth, pay it off, withdraw, pay it off. After those 5 years, the repayment period kicks in, where you're not only paying interest payments on whatever you owe, but you're also paying on the principal on that. So the only advantage you have with this is you could essentially borrow the money, use it for something else, pay it off before the payoff period begins. Before the period starts for you to pay the principal on it. Okay. And this allows you to have this money that you can spend however you wish. But of course, with everything else, there's some risks involved. You have a revolving line of credit, just like a credit card. The interest rates on home equity line of credit vary. They go by prime rate. So you have to be aware of this. It's like a credit card. The interest rate can be high at a certain period of time, low at certain periods of time. Like with any kind of loan that is guaranteed by your home, there's always the risk of foreclosure if you do not pay it. People normally experience what we call a payment shock because during the draw period, before the draw period ends, which is where you have the money, you can use it anytime before you start to pay principal, you're only paying interest. But when the repayment period begins, you're paying full principal plus interest. And your monthly cost can go up significantly. So you need to know how home equity line of credit really, really works. What is this good for? Again, I would not recommend doing this for daily expenses like grocery shopping or pumping gas. I would not recommend home equity line of credit for that. This requires a discipline because it's a credit card you have against your home, so you can tend to overspend. Remember, rising interest rates and falling home values will heavily affect the interest on this home equity line of credit and how much your payments are going to be. So this one is not going to be a stable payment. It's going to fluctuate, go up and down depending on the interest rate at the time and also depending on whether you have hit the repayment period. I would recommend watching this video. It is very informative and very, very good if you want to know more about home equity line of credit. Another way to fund your project is cash out refinance of your mortgage. What is a cash out refinance? Essentially, what you're doing here is you have the equity on your home. That 100,000, I'm going to use that as an example. Your home is worth 500,000. You owe 400,000. You have 100,000 in equity. The lender will typically reserve 20% of whatever that equity amount is, and then they'll give you 80 or so percent. So let's say you get 80,000, right? When you cash out refinance, basically what you're doing at that time is you owe 400,000. Your home is worth 500,000. You are going to take a loan for 500,000. The bank will give you the 80,000 equity, of course, minus the 20%, in cash and give you the loan for 500,000. What you just did is you just reset your mortgage. You just took a bigger mortgage on your home and withdrawn the equity out of your home. That is what a cash out refinance does for you. You get a large sum of money instantly. It's a lump sum. Okay. The advantage of this is it's a single loan. Basically, this loan replaces your original loan. It is not a second loan. It is one loan that you're still paying because remember, you are refinancing your loan. So basically, the bank will pay off your old mortgage, give you a new, bigger mortgage, and give you cash on the difference between what you owe and the equity on your home, okay? So just consider this as one loan, but a bigger loan. You can deduct taxes if you use that equity money for some improvements, but consult a tax advisor. What are the cons of using this? Well, you just took a bigger loan on your mortgage, on your home. So is that home in Kenya worth this? You really need to consider that, right? This one comes with closing cost. Yes, there's definitely closing cost when you refinance your mortgage. And those closing costs can be 2 to 5% in fees. Remember, by doing this, you're basically taking the equity out of your home. Your home may still be worth 500,000, but your loan is also 500,000. There's no more equity left. You pretty much did a reset. You press a reset button on your mortgage. You're basically restarting the clock. This, I also would say, do not use it on everyday expenses. It also goes, typically, the lender will require 20% of the equity amount, they will never give you 100% of the equity that you have on your home. So you just need to be aware of that. Personal loans. This is another way to fund your project in Kenya. A personal loan does not require any collateral. It's unsecured loan. They give you a loan, no strings attached. Of course, it requires a good credit score. They will check your income to make sure you can afford to pay that loan along with your normal obligations. There's always a fixed interest rate on a personal loan. These are normally very fast to be approved. If a bank or a credit union approves a personal loan, you will have the money in your account within days, sometimes even within the same day. You can use this money however you wish. So it's basically a loan without any strings attached, but you have to repay it. This is probably one of the easiest ones to get, but also one of the most riskiest ones because you get a lot of money at once and it is very easy to abuse this. And I know people who have done it. The interest rates tend to be higher than if you take a home equity loan or a home equity line of credit. But also the interest rates are going to depend on your credit score. So you be aware of that. Taking this kind of loan will hit your credit score because it's going to show up on your credit score. It's also going to impact your debt to income ratio. Basically, the amount of money you owe. And if you go to apply for any other loans, they will always consider your debt to income ratio. Some lenders charge origination fee on this type of loan. The payment periods can be 2 years to 7 years. So I would say, everything else aside, if I was to use, and I've actually used this personal loan myself, when I was doing major projects, for example, putting on a roof in the house, I didn't have all the cash at once. I took a personal loan on that and I paid it off. That was a big lift. So if you are going to use this, I would say only take the amount you need and focus on paying it off. But this is probably one of the easiest one, and this is probably one of the ones that's easier to abuse too. Credit score matters. The better your credit score, the better the loan terms you'll get. You need to shop around. I personally prefer taking them from a credit union versus a regular bank. Most banks will give you very poor terms, very high interest rates, while credit unions will tend to give you better interest rates. Instead of a personal loan, you can also consider things like buy now, pay later. PayPal has something called PayPal credit. If you're buying something and you're buying it online, probably PayPal credit is the best way to go. But that's typically 6 months, no interest, free financing from PayPal. But be careful because after those 6 months, if you have not paid off the entire balance on PayPal credit, the interest rates can be 32%, 35%. That is high. So if you're considering financing, personal loans is another way to go about financing your project. Credit cards. You could use credit cards to fund your project at home. I would not recommend it. Why? Because interest rates on credit cards are very, very high. Interest rates on credit cards are variable because they go up and down depending on market conditions. You have instant access to a lot of cash if you're using a credit card. Some credit cards have the option to cash out if you want to do cash out. Some of them give you rewards like airline credits, things like that. Plus, using a credit card tends to build your credit score if you pay it on time. So this is a quick way to have money, but the biggest drawback to credit cards are that the interest rates are not fixed and the interest rates tend to be very, very high because they're not secured. If you only make minimum payments, you can spiral into a chain of debt. That is the biggest problem that most people have with credit cards. It's easy to use, but if you don't pay off the balance at the end of the month, you can quickly spiral into a debt problem, which could actually damage your credit score, which will then affect the amount of credit you can get from lenders. So this is just things like something that keeps feeding itself and just feeding itself. What do you consider? I would say if you can, pay the amount in full every month to avoid interest or escalation. They do offer balance transfer options, so you could transfer balance from one card to another, which can buy you another 6 months before you you have to pay again. So you really need to be careful about things like that. If this is the only option you have, this is another way to finance your project. Personally, I've never used credit cards to fund my project. Last but not least is taking a loan from a bank in Kenya, right? If you are in a position to do this, this is probably the best option for you. If you are able to do this, take a loan from a bank in Kenya. What are the pros? This does not impact your US credit score. This does not put your home at risk in the United States. This will also help you build credit with a bank in Kenya. You borrow less, you pay it off. You borrow a little more, you pay it off. You borrow a little more, you pay it off. And before you know it, you are able to borrow quite a lot. So if you're able to get this, this is probably the better way to go. But why are we not doing it? Typically because the interest rates are high. The repayment periods are very short. These are not 30-year loans. They tend to have much, much shorter repayment periods in Kenya than we do in the United States. The process of documentation can be painfully slow. It can be convoluted. It can be challenging. But if I was to do this, I would highly recommend travel to Kenya, do it while you're in Kenya, instead of emailing your private data back and forth to somebody's email in Kenya. I would recommend travel to Kenya. If you're able to get a loan, apply for it while there, process it while there, and then come back. Typically, most banks, just like any banks in the United States, they require collateral for these types of loans in Kenya. Be aware that if you don't pay, just like with everything else, you could lose your land or your home or everything. So just be aware that this is collateralized debt in Kenya, and you still have to pay it just like you pay it in the US. So you have to consider the best way to do this is open an account to establish a relationship with a bank in Kenya before you even apply for the loan. Personally, I have opened accounts with NCBA, I've opened accounts with Equity, Cooperative Bank, and Stanbic, right? And why so many banks, you may ask? Well, it's because I wanted to test and figure out which one do I want to go with. I don't know most banks in Kenya, but I'm trying to figure out which one is the best. I'm going to make a whole video about this because that's another experience in itself. The pros and cons of each bank. Equity, Stanbic, Cooperative Bank, what's the other one? NCBA. I've had them all and I still have accounts with them. And I can tell you they're all completely different from each other. What should you consider? Again, consider opening an account while you're in Kenya. Consider opening an account before you apply for a loan. Remember, some of these banks, if you don't have any ongoing transactions with the account, they will ask you for your M-Pesa statements just to see how much money flows in your account between Kenya and the United States. But all in all, this is still a loan. Make sure you have enough income in the United States to cover this loan in Kenya, plus your household responsibilities in the United States. So I'm going to wrap the video there. Today, we covered a lot of topics on how to fund your project in Kenya. We went through multiple ways to fund your project, and just to recap them real quick here, we went through cash flowing the project, takes time, 401k withdrawal, penalties are involved because you're actually taking money out of your 401k, 401k loan, you are loaning money from your 401k. If you lose your job, the loan becomes immediately payable within 60 to 90 days. Home equity loan, you are taking a second mortgage or a second loan on your home. Home equity line of credit, you are using your home as a credit card. Cash out refinance, you are basically cashing the equity out of your home and taking a whole new mortgage loan, which is a bigger mortgage than what you originally had. Personal loans, these do not require any collateral. It's like a credit card without collateral, but with low interest rates. These are probably the better ones. If you had to choose, this is probably the one I would choose. But you still have to pay it. The interest rates are still high. Credit cards, we all know how they work. I'm not going to go over that again. Loans from a bank in Kenya, this is another option, but you have to build a relationship with a bank in Kenya. So I know we covered a lot, and I would recommend watching and rewatching this video. If you have any questions, please feel free to message me directly. Subscribe to my channel as we continue along this journey. On the next topics, we'll start talking about finding contractors, sourcing contractors, hiring a project manager, quantity surveyors, all those names you hear when you're trying to build a home in Kenya. Join me on the next video, which should come out probably in another week or so. I look forward to seeing you. Thank you.